All right, I think we're recording. All right, and then let me just share. Okay, just hey, this is purely educational, and please use your own professional accountants and advisors to make decisions. But with that, that's all I had, Aaron. I just wanted to make sure I had my disclaimer. So it's all yours.
Awesome. Cool. All right, let me share. All right, let's go into present mode. Cool. All right, thanks everyone for joining. My name is Aaron McDaniel. I am one of the managing directors, founding partners of GrowScale. We're a real estate investment company. Thank you for being here today. I would love to make this more of a dialogue than a monologue. So I have some slides that we can guide our conversation. But ultimately, I would love to hear what's on your mind, and even if it comes down to challenging some of the things that I'm saying, totally fine on my part. I do recognize some familiar faces who probably have heard similar things being talked about. Some of my investors on different deals are on the call, but we're here to talk a little bit about opportunities that are created during economic downturns, and then in particular, related to the hospitality industry, where we see a unique opportunity. And so, as Bobby mentioned, this is meant to be an educational session. Love to hear where your thoughts are, have a dialogue about what's going on. So let's jump right in. So what we'll talk about is some of what we're seeing now when it comes to the market. We'll talk about some strategies when it comes to different asset classes: retail and office, multifamily, hospitality. And then we'll also be talking about different hospitality trends during COVID and things that we're seeing. So just by way of background, in terms of who I am, so I am, career-wise, I had a corporate career at AT&T for about a decade, was part of their leadership development program, was a serial entrepreneur, had a number of companies, including 3 that successfully exited. And then I also teach at UC Berkeley's Haas School of Business. I teach entrepreneurship there. But in terms of real estate investing, I've been investing for about, almost 15 years now, give or take. I started at like the worst time possible in 2006, right before the bubble burst with the whole mortgage crisis. And my very first experience buying a house was out in the East Bay, Antioch, Pittsburgh area. And I bought it for $500,000, went up to $550 in like a 6-month period. And I was like, yeah, this real estate stuff is easy. This is great. And then it went down to 170. And everything that they talked about in the movie, The Big Short, was like situations I was in. I was in like a negative amortization loan. I didn't understand the balloon payments. I found out later that the agent I was working with kind of committed fraud with the appraiser to get everything approved. And it was just pretty nasty. And then I think, to add insult to injury, the very first tenant that I had in that house paid rent for a couple months and then stopped. And I had to go through the whole process and get them removed by the sheriff. And when I actually came in to repossess the house, I saw that they stole my washer and dryer. And I was like, man, this real estate stuff is hard. And so, but I think it gave me at least a pretty interesting perspective, especially as we were just hitting this economic downturn, because I wasn't necessarily as euphoric and a little more cautious, knowing that the good times don't always last forever, so to speak. So for me, I had at the bottom of the market bought a number of houses in the San Francisco Bay Area, in the East Bay, and then moved over a few years ago into multifamily. And so my business partner, Wen Wei, who just joined the call a moment ago, who will also be chiming in as we go through this presentation, he and I started GrowScale. We started initially with our own capital, investing in mainly workforce housing, Class C apartment complexes. And we focus in particular on what we call sub-institutional multifamily. So not the duplexes, quadplexes, eightplexes that a lot of local investors focus on, not the big institutional deals, but this sort of middle ground that's too small for the institutional investors to go down to, a little too big for a lot of smaller investors. And what we typically found is a number of owners of these type of properties are more mom and pop type owners who have built up their portfolio over time, built up to this type of property, and typically were prioritizing cash flow as opposed to staying with market rents and other efficiencies. And so in buying from them, we often are able to find an upside on rents and to be able to operate some efficiencies on the expense side as well. So we currently, at last check, we had about 700 units in a number of different areas across the country, in Washington State, in Tennessee and Kentucky, in North Carolina, a little bit in Texas. And then over the last 2-3 years, we've made about 12 acquisitions in the Minneapolis, St. Paul area. And so we take this, more agnostic approach to specific areas. We've been able to build an expertise around operating properties remotely out of state. And so as an example of, in about 2016 or so, we got into the Portland market and did pretty well, saw that the writing was on the wall there in terms of some of the things coming down the pipe with rent control and how expensive the properties were. And so we decided to move out of the area. And so the strategy in us identifying different markets using big data has served us, because if you focus strictly on one area, typically what happens when there are no good deals around is either you're sitting on the sideline doing nothing, or you're putting money into bad deals. And so Wen likes to say, we know that it's time for us to sell when we wouldn't be willing to buy the property we own at the price that someone else is willing to pay. And so that's typically how we've made our decisions in terms of that. So that is background. Wen, is there anything you want to add just to pull you into the conversation before we jump into the content in terms of background or an introduction on you?
No, I think you covered all the bases for the both of us. Like Aaron said, to kind of reiterate, we've been in doing real estate and commercial real estate for the last 5 years, and real estate for the last 15 years. So, yeah.
Yeah, and at a high level, as I went a little deep on the multifamily side. Typically, what we have done is we focus our general partner or sponsor efforts on multifamily or something with a multifamily connection to it. But we have been limited partner investors in basically like all of these asset classes, where we work with other general partners who we built relationships with and have seen a good track record from. So we do have some familiarity with these areas, if not operating them as the sponsor. So some of what we're seeing now, just going down the list, asset class by asset class. So hospitality fell the fastest, and likely for some of these other, outside of multifamily, for some of these other asset classes will likely recover the fastest. And part of that is because one way to look at multifamily one way to look at hospitality is, compared to a multifamily scenario, the signals you get in terms of changes to the market happen over months period of time as people are rolling off of leases and things along those lines. Whereas hospitality, you're getting that feedback on a daily basis. And so it's much more immediate. So I'll show some information, but there was just a very drastic drop when it came to hospitality, but they're in different segments of it have seen a more rapid recovery closer to pre-COVID levels. When you look at retail, that has been really, really, really tough. I mean, there's been a lot of rent abatements, a lot of rent deferrals, owners doing everything they can to keep these retailers afloat. Some of it, depending on their financial strength of a corporation versus individual mom and pops. Those are very different retail experiences in terms of payment and other things from owners. But we'll talk about it a little bit more in detail. But some of these areas, one question that goes through Wen in my mind as we've been thinking about this is, and it's not a one or the other scenario, it's more of a spectrum, but it's what is going to snap immediately back to how it was pre-COVID as we start to get out of this, and what is going to be drastically changed forever. And so, and to a certain extent, what are some things that that COVID helped accelerate, maybe that were going to be happening at a slower pace, happen much more rapidly? And so you look at retail as an example, and online sales, as people have had to be sheltered in place and other things, it's really pushed on retail. So, you know, if you look at just a few days ago in Black Friday, the online shopping during Black Friday was I don't remember the exact term, but it's tens of percentage points higher than in past years, whereas the brick and mortar is, you know, down 75%, something like that. And so, but again, the question is going to be, how much is that going to snap back? Then on the other end, there's office space, where we see that there's going to be a lot of long-term effects. Not every company is going as far in this direction, but you see companies like Twitter saying we're going to be completely remote. Others are allowing for more flexibility, which we think could cover in the long term, especially as different people have moved out of urban centers because of COVID. Again, some of the question is whether they're going to come back or stay permanently outside of those metros areas. But if you look at San Francisco as an example, rent is down upwards of 30% in some pockets, because so many workers have just decided, I'm going to not deal with the high cost of living here. I'm going to go somewhere else. Some of them are negotiating with their employers to take lower salaries to live in a place where there's a lower cost of living. And then multifamily. So what we were anticipating it to be a lot worse than it has been so far. You know, knock on wood. I think some of that was just in terms of the number of holdings we have. Some of that was in part because of government stimulus keeping things up. But there's just an incredibly low inventory. We found for a long time there wasn't a lot of the downside risk built in from sellers in terms of the pricing. They were sort of thinking, hey, this is like pre-COVID. And so they weren't necessarily willing to adjust for the new world we lived in. And so that really lowered the inventory of good deals that we found. So we've started to see in the last few weeks, it's picked up a little bit more. We're starting to see more deals. But for a while there, it was, you know, I think part of it was, one, sellers who were out there not wanting to lower their pricing because of everything happening. And then two, the other side, a lot of people who might be in the market to sell were holding back just to see, okay, what's going to happen. And so, and then like I was alluding to previously, in some of the gateway markets, there's much more market distress than some of the other areas because people are moving out of urban centers. A lot of the benefits of living in these urban centers have been shut down because of the pandemic. And then all of this is compounded or influenced by the fact that we're in a very low rent environment. And the thought that we've seen in terms of indications from the Fed is that this is going to be a low rate environment for the next couple, 2-3 years even. And so, you know, that's going to play into the speed of recovery. It's also going to play in terms of what types of deals are out there on the market and what type of yields different buyers are going to be looking for coming into buying deals. Wen, do you have anything to add?
Yeah, I mean, disclaimer here, right? So, I mean, we don't really know what's going to happen after COVID. I mean, for example, there's been a lot of development in the office space asset class where, you know, there's a potential for, you know, certain pockets like suburban office to actually do quite well because, you know, people are moving out of urban centers, more concentrated areas, but they still don't want to work from home, right? So they still want to go to an office space to conduct their work. So a lot of big companies are actually doing some type of a hybrid model where they're renting out office space within, you know, within kind of like concentrated pockets of their employee where their employees are living in suburban office parks. And, you know, and the fact that, you know, COVID has essentially scared everyone out of these really concentrated office environments and requires more personal space, there's potentially a higher demand in office suburban office space in the next 5 years. So yeah, I mean, the jury's still out on which of these asset classes are going to have long-term distress. But from all indications, I kind of feel like with everything, I think retail may be hurt the most and maybe bouncing back the slowest, but all the other asset classes feel like there's maybe a faster recovery. So
cool. So along those lines, just to delve a little bit more into retail and office, in line with what Wen was saying, we're actually investing in both a retail and office deal at this time, that we were able to see some pretty good pricing opportunity because of discounts occurring because of what was happening with COVID. But in particular, in these situations, we focused on very highly credit rated tenants, as opposed to a building that's more of like retail, like more of a strip mall with a bunch of small businesses, or an office with a lot of individual lawyer, accountant, service-based type companies. So stay away from those. But if you can potentially find good deals because of some of the price dislocations that are happening with quality tenants. So one of the properties that we just recently invested in is as limited partners, is in Michigan, in sort of suburban Detroit area, and it's a Walgreens and Dollar Tree. And so, two pretty strong credit rated tenants, and obviously the terms associated with the leases and other things are important as well in that case. And then with office too, if you can stick to what GrowScale's strategy is, which is always buying based on actuals, based on the trailing 12. If you're able to buy retail at a market type price, but based on a very distressed last 12 months because of COVID, then coming out of it, there's opportunity for those to be good deals, if that makes sense. Anything to add, Wen?
Yeah, I mean, in general, just have much stricter underwriting, right? So, I think a lot of brokers are, for distressed deals, they're always going to kind of paint a very rosy pro forma. I would just kind of urge everybody to kind of come up with their own assumptions and be conservative.
Yeah, exactly. Let's stop there for a moment. For sake of dialogue, anybody have any questions or maybe something they've read as it relates? We'll go into the other asset classes, but let's talk about retail and office that they saw, insights that they have, or questions, or otherwise. We'd love to hear that.
Yeah, folks, you can, since we're a small group today, you can unmute yourself, or you can chat in the Zoom chat box, and Aaron and Wen and I will get the questions.
Sure. This is Joshua. I had a question.
Hey, Josh.
Hey. Anyways, thanks for the intro, and wanted to ask, in terms of the retail space, I'd also read some articles, or I can't remember where I got this information, but even some of the corporate, what you would consider kind of Class A tenants, sometimes they just pack up and stop paying and leave in the middle of the night. Obviously, when you're trolling around for deals, you got to take risks. But what is your thoughts on that situation?
Yeah, so I think it really depends on the credit rating of the. You obviously kind of have to. This is a case by case basis, right? So, like you have to believe in the tenant. First and foremost for retail. So when we underwrite retail deals, I mean, we don't necessarily have all the experience in retail like some of the other GPs do, but as limited partners or LPs in deals, we just absolutely have to believe in the tenant, right? For example, if it's a retail chain that's been kind of on the downward spiral, but they were previously rated great. It's just, there's a lot of risk that comes associated with it. But if you feel like, if you've done your research on the tenant and you're comfortable with their business model and they'll survive COVID and they're credit rated, I kind of feel like that, and the price is right for that property, then you can kind of consider it. So I think it is case by case.
And I would also really highly look at the industry that tenant is in as well, that company is in, because, look at the effect that COVID has had on that industry. There are a number of industries that have actually benefited from COVID. And so, depending on where they fit on that side, that's an important consideration as well.
Yep. Like, for example, like medical right now is fairly strong. So a lot of, kind of medical research firms are actually benefiting from the current environment. So it just kind of like, I would say don't take COVID as something that's going to be permanent, right? Like be like, just like anything, underwriting a business, underwriting anything, you kind of have to take COVID as what it is, assess the risks as, near term, and then figure out where that tenant is going to go in 5 years. So, yeah.
So let me just, I guess, offer another lens on that, building off of what Wen said, which I completely agree. You also, depending on where you're located, if is everybody on the call from the Bay Area, Bobby, or throughout California?
No, not everybody.
Okay, but I'll use the Bay Area as an example, right? The Bay Area is its own sort of echo chamber of things, and because of the Silicon Valley, it tends to be a little more forward thinking and moving in some of these concepts. Like an example, when Mark Zuckerberg said, "I'm going to take time off for paternity leave," all of a sudden that became a big thing, and all the other companies locally had to kind of do that. I'm not expecting companies in droves to do what Twitter did, which is say we're going completely remote. In other areas of the country, it will go back exactly to the way it was. Like, John Deere Tractor Corporation or something, they're not going to go completely remote with their corporate staff, right? They're probably going to go back to something closer to what it was like before. So, just kind of keep that in mind in terms of the location. Cool. And any other retail office questions? Thank you, Joshua.
Yes, we've got some questions from Mary Jean. What has been your experience in repurposing larger strip malls away from retail to something else?
To anything else? Just what else has it gone to it that you've seen, or have you crunched any numbers?
You're talking about strip malls in particular?
Yeah, like a big strip mall that might have like a dollar store at the end or something like that. Like not necessarily a teeny tiny one. I guess you call it like a medium-sized one. Not a huge mall with Anchor, Pennies, and other, but kind of mid-sized strip mall type of thing.
Yeah, to be honest, we don't really have experience with that asset class. So
okay.
Is there something you're hearing in particular that's strategies? I mean, I'm hearing in the like bigger mall space, you're seeing like Amazon come in and wanting to use those as like,
Well, yeah. I mean, there's that. There's people talking. It takes a lot of rehab. Making them to, senior livings type of places. With a lot of walkthrough space, but it takes a lot of money, if you will. I mean, turning them into warehouses is basically a little bit better strategy, if you will.
Yeah. We don't have much experience in that conversion, unfortunately.
But I think along those lines, we'll talk about when it comes to hospitality, we see opportunity for conversions.
Right. Okay. Thank you.
These do create opportunity.
Hey, Aaron, you're cutting in and out a little bit.
I am?
You're fine now.
Okay. Bobby, did you have any other questions from the
Vinay
chat?
had a comment. He's seen Sears becoming reused for D&B. Vinay, what is D&B?
It's a gaming space. I think Dan and something.
Dave and Buster's?
Oh, Dave and
Yeah.
Buster's. Dave and Buster's.
Yeah.
Yeah. It's Dave and Buster's when COVID is gone and pandemic is gone, I think they'll do pretty well. So will yeah, a lot of other similar places. But I don't think Chuck E. Cheese is coming back, but others are going to be okay. um, Dennis has a question about older motels.
Yeah.
Hey, Dennis, go ahead and unmute yourself, buddy, and ask away.
Yeah, I just wondered if you guys in your hotel search, you know, have come across any of the older motels, the old, you know, roadways and travelers inns and Motel 6s and all of that, that may not come back as motels, repurposing those for other types of housing.
Sure. So we'll talk about this in a little more detail as we get into the hospitality part of the conversation. Okay. But just to answer you at this point, most of our focus when it comes to hotels, where we see an opportunity, is repurposing more of the limited service hotels as opposed to the budget hotels. Right. But we have looked at deals in the past. Like Wen and I were looking at a deal that was just outside, like right adjacent to the old downtown Reno, where some of the, you know, a couple casinos were, and it was one of those old style type motels. And it just, we couldn't wrap our head. I mean, also Reno is a pretty hot market, right? So we just couldn't wrap our head around the price that they wanted, as well as some of the transients of some of the tenant base. So I think it really depends on the specific area. I mean, that area could have been good. Actually, like directly across the street from this deal that we were looking at, there was an Apple distribution center that they had built up. So Wen, I don't know if you have anything to add, but different type of tenant base.
Yeah, I think let's talk about it when we get to the hospitality side.
Yeah, I think we're at 12:30 mark, so let's continue deep into.
Well, we have an hour total. Is that right, Bobby?
Yeah, total an hour. But
yeah, we want to leave time for questions at the end.
Yeah,
okay.
Yeah, exactly.
So multifamily, you know, there's an opportunity with your existing portfolio if you have something to refinance, capture lower interest rates. You know, you could do things to improve unit fundamentals to boost your yield. You could pull some of that cash out to find some of these distressed deals as well. It's also, you're going to have to go out there likely and find new deal sources just because the inventory is pretty low. Or, you know, as was aptly brought up, you know, maybe look for ways you can convert to multifamily of different types. So let's dive into hospitality a little bit more. So there is quite a bit of distress in that area. There's different levels of distress depending on the type of asset. So we're not looking to lump all of hospitality together. If we had to break it into some general categories, you have more of the resort style fly to type locations. Those are in big trouble. You know, they're experiencing a lot of distress. There's not even a lot of clarity on when those will rebound back to the levels they were at before. Then there's also what are labeled as full service hotels. Those have been in particular distressed because they rely heavily on their conference and meetings business or other restaurants or other elements beyond just guest room rental fees. And so numbers we've seen are around maybe 60% of revenue comes from corporate. And so that's presented a big problem because a lot of that has not recovered. You know, a lot of those are also connected to airports where, you know, flight traffic is considerably down because of COVID. And then there's the area we focus a little bit more on, which is limited service. And we've seen a lot of that bounce back. I'll show some figures on that in a few moments, but it's not as heavily based on corporate, you know, 20% or less. And a lot of it is more extended stay corporate, like nurses travel a lot. And so, you know, having, or, you know, someone who's a contractor as part of construction projects, something like that, they're more likely to stay in that type of hotel that has, you know, that's in more of a suburban area or closer to some major employers or hospitals or things along those lines. And so, you know, so what we've also found in some of the deals that we're looking at now and bringing under a contract is that There were a number of people who bought at the height of the market. Maybe they weren't as experienced of an operator. A number of them also over levered. So they had loan to values of over 90%. And all of a sudden, when your income goes from, we'll say 70% occupancy down to 5 or 10, that's big trouble. And you can only last for so long. And so what's happening is a lot of those owners are in the process of, or have already run through forbearance with their lenders. The lenders have gone, into foreclosure, and these owners, operators have defaulted. And so the lenders have repossessed it. They're saying, like, I don't want to operate these hotels. And they're more willing to give pretty solid discounts. We're seeing upwards of 30% discounts off of pre-COVID pricing. And they'll even often continue servicing the loan because they like the asset. It's just they kind of take a haircut on their price. So there's also an opportunity in particular, again, in light of what we're discussing, to do some conversions, hospitality to housing. There's always a big need as of recent in a lot of areas for affordable housing. There's not a lot of new builds because of COVID. And so there's opportunities to not only purchase below replacement cost, but also purchase below what the per unit multifamily prices would be, which, if you buy the right asset and it has the right level of renovation, you're able to capture a good amount of value in converting that over to multifamily. Anything to add, Wen?
Nope.
So as I mentioned, just to share some trends here, the dark green line are more luxury, upper upscale. The lighter green line is more upscale or, upper mid-scale, or, more of these full service hotels, Marriott's, Sheraton's, etc. And then the lighter blue line is what we've more focused on, which is more of that limited service hotel. And what we've seen, they obviously all immediately took a big hit, but the limited service wasn't as affected and has actually rebounded quite a bit, upwards of around 20-25% below what's normal. And again, it creates that opportunity if you're able to buy at a distressed price. And we've seen that as well. So we've been limited partners in hospitality deals and in this type of limited service deal. And we didn't have any call for capitals this year. We're actually seeing some level of cash flow as well. So it's been able to weather things much better. And then just some other data that supports that, what we're talking about in terms of these limited service hotels. A lot of these are more tied to drive travel as opposed to plane travel. And, plane travel is still significantly below what it was before the pandemic. But you can see, it's only 9% down year over year for drive trips. And you're seeing a lot of families actually extending what would be the typical summer holiday travel season extended into a lot of the fall because people are still wanting to take trips and they couldn't necessarily, or didn't feel comfortable going on planes. So they were finding drive trips and staying in these type of hotels. The other thing of note, if you look at the last couple of recessions, when you saw these big dips in the market, typically that 12-month period post have seen pretty strong recoveries. And so if, not always, right? Past performance is never indicative of future results, but looking at some of these trends, you can see that if it falls in line with that there is, an opportunity for a faster recovery. So, as we talked about, some of, staying away from more of these full service hotels in gateway markets where it's near airports, where it's more about fly to traffic and more focused on the drive to traffic, and then having the right brands as well. So, there was a question just around like budget versus limited service. The way budget hotels operate, there's often not as much room for some of the management costs associated with it. And that's why a lot of those hotels are managed more by mom and pops. And so, this is going into that limited service segment, there's a little bit more room for professional management and to take advantage of some of these efficiencies and ultimately having a little bit lower of a risk profile from budget hotels. Anything to add, Wen?
Nope.
Cool. So yeah, so here's, just some example deals that we've seen in our pipeline. It's some of it, what we're also seeing is an opportunity to rebrand. The way we like to say it is it's like taking a Toyota Camry and converting it to a Lexus, right? I mean, in a lot of ways, the actual car is pretty similar between a Camry and a Lexus, but the branding associated with it garners a premium. And so what a number of hotel brands are doing right now, as long as you stay within the hotel group, they're more willing to waive termination fees with a brand and either waive or lower initiation fees. So it gives you the ability to move between one brand to another. So there's one we're looking at now where we're moving from a Wingate to a Hampton Inn as an example. Hampton Inn is generally considered more of a premium brand within that limited segment and therefore can garner higher room rates. And then here's an example of a conversion. So we talked about suburban areas. A lot of these conversions, it's a very particular type of asset we're looking at, like more of the extended stay type hotel, because when you have in more of a garden style as opposed to a high rise that's in more of a suburban area, not necessarily near an airport, and having those makes the conversion a little bit easier, and it's not as much of a leap. Like a lot of people don't necessarily want to live in a high rise right next to an airport, but in a garden style property that feels like an apartment complex that has amenities like apartment complexes do now, it already has like a built-in kitchen and things. It makes it easier. One subsegment of conversions as well for the right areas is in the student housing segment, where you're able to find hotels that might be near universities and convert those into student housing. As in, COVID aside, the student populations for a lot of schools have been increasing. Enrollment has been increasing in a lot of colleges. So that one in particular here in Oklahoma, there's also retail tenants that are part of that. So bringing in a Starbucks coffee, bringing in another restaurant and retail tenant as well, can basically help boost when appropriate, and the asset allows for these things. So went through that content. I think hopefully we got about 15-20 minutes for Q&A. So would love to take that as a basis and see where the conversation goes. What do you guys want to talk about?
Yeah. Thanks, Aaron. Thanks, Wei. Folks, look, this is a time, if you've had questions about, how to analyze hospitality deals, how to, source them, whatever comes to your mind regarding, hotels, hospitality, investing, and so on and so forth, maybe geographical regions. But Aaron and Wen, they've been really involved in hospitality and as LPs and in real estate and commercial space. They know how to analyze, they know how to source, they know how to deal with brokers and commercial loans. So, feel free to ask your questions, so go ahead and unmute yourself. And if you got comments, questions, just go for it.
This is Joshua again.
Hey, Joshua.
So maybe you could tell us about, my understanding is you're looking to put together an opportunity fund to kind of put together a little war chest to go after some of these things. Or are you planning to kind of approach people on a deal by deal basis?
Yeah, so I guess I'll be careful about what I'm sharing just because this is a public forum, right? But ultimately we're putting together a fund to take advantage of this. The reason why we're doing a little more of a fund structure instead of deal by deal, which we typically do, is just because of the need for us to have committed capital for speed. Mm-hmm. So you know, a lender comes and says, hey, we're willing to give you a 30, 35% discount. We're not going to wait for 90 days for you to put everything together. We need you to move faster. And so we want to be able to have that capital ready to go out there.
Okay. Thank you.
Sure.
By the way, Aaron, and when speaking of having liquid capital, I was talking to a commercial broker, I think it was late last week, and there was a hotel in Santa Clara that was pre-COVID valued at 16 million. It had the note, they went into foreclosure. Long story short, the note was sold for 3.9 million because it was all cash. The lender wanted all cash, like immediately. So somebody who had 4 million laying around picked up that asset for 4 million. And this is a Santa Clara property. So I think that's the power of having liquid cash available to execute on those discounts.
Yeah. I mean, that'd be the cost of what, like a 8-plex or something, right?
Yeah.
No.
Yeah. But yeah. Anything else, folks? We will probably have a more in-depth presentation for accredited investors probably in about 10 days or so, maybe. But we will dive into the fund structure and how you can participate and all that. So stay tuned for that one. Anything else from?
I have a question. This is Chester.
Yes.
So how much cash or commitments have you raised so far, and how far out in your estimate is your first purchase?
So we have multiple properties under LOI right now. They're going to close in probably early to mid Q1 next year. And I think right now we're at a little more than $4 million raised, give or take.
Okay.
Yeah.
And when will you be ready to send out for more additional documentation?
Yeah, so we're working with our attorneys now on the offering documents. So we actually have been having calls earlier this week. I think the deadline we got is maybe in a week and a half. They'll have them ready for us to share.
Okay, thank you.
Sure.
And so, folks, Josh, Chester, and all, Dennis, everybody, we will have a more as soon as the attorney approves the documentation or near close to those dates, we'll probably have a more in-depth accredited investor presentation. So look out for that announcement as well. But Aaron, any other ways in which hotels, I'm seeing articles around where hotels are converting or allocating some space for like co-working, you need maybe a small private space for, instead of going to WeWork, you can go to a hotel and work from there. You got Wi-Fi, you got the big monitors, you got coffee in the lobby, and you got, privacy. I think I'm seeing a lot of those conversions also taking place. Have you encountered any other interesting use cases?
I don't have anything that I've seen in the form of a deal. I think there's little things like that where I think it's, out of necessity, these owners are like, I got to figure out something. I haven't necessarily seen something in a big cohesive way, except for the multifamily piece. And just as a side, part of the reason why the multifamily conversion isn't necessarily the easiest thing is because there are not a lot of sponsors, general partners, whatever you want to call it, investors that have experience in both asset classes. So actually with what we're doing with our fund that was mentioned, we are actually teaming up with another company, Area Investments, who we have been limited partner investors with, who have, I think their whole portfolio is like almost $100 million of different types of assets, a majority of that in hospitality, limited service. So they have a lot of experience in that area from a hotel perspective. We have a lot of multifamily experience. And so you can't necessarily just buy a hotel and immediately convert it to housing. Like that Santa Clara example. Yeah. If they wanted to convert it to something else, they would have to either play out the rest of that contract with the hotel brand, or they'd have to pay a very steep cancellation fee. Yep. And so that presents an interesting opportunity in that we could buy one that's in the last few years of its contract, operate it as a hotel because our team has that expertise, and then do the conversion. And while it's operating as a hotel, go to the city, change the zoning, figure out all of the renovation plans and everything that's needed to actually do that conversion.
Yep. Makes a lot of sense. Yeah.
I have a question, Aaron.
Yeah, Dennis.
So are most of the deals you're coming across, is it coming through brokers? Or some
are through brokers. Most at this point are through lenders. Like in terms of this opportunity, we think that like we're maybe a little bit ahead of the opportunity. We think it's really going to come about 6 months from now when there's a lot more defaults that are happening. Like I feel like the types of deals we're seeing now out in the market are like the house of cards that we're going to fall anyway, because it's an inexperienced operator who is way over levered. Like I was telling you, the other one, I think that we have under LOI is like, it was 93% loan to value or something like that. So that's just kind of a recipe for disaster. So we think as time goes on, the number of properties as well as the situations are just going to expand a little bit, because people are going to eventually be running out of cash and eventually just have to let go of things. But to this point, it's been mainly the lenders who we have relationships with that have said, we are foreclosing on this. We don't want to operate a hotel. We need somebody to come in and buy this.
Got it. And that's why the fund structure makes more sense, because you have, this will happen over time, so you can execute on different projects as they become available opportunistically. So yeah. And Aaron, is the lending, what do the lenders look for in a new buyer? What are some of the, we know in commercial multifamily, you got Fannie Mae or Freddie Mac kind of underwriting procedures, but in hospitality, what do they look for? Are these, I'm sure they're non-recourse loans, but can you touch on their financing requirements?
Yeah. So, I mean, the key really is reputation and relationship. So, if you're not a known entity to that lender, they're looking for someone who they have confidence with, who maybe they've lent to before, who they know you have a lot of experience. They're not just going to go to the general public and say, hey, we got this property, like anybody take it. They're going to go to the people they know who would operate this. There's a little bit of haggling on price because, the bank wants to maximize their losses. The lender wants to maximize their losses. The investor obviously wants to make it as big of a discount as possible. But then once that is met, there's a confidence that new operator is going to be able to weather the storm because of experience and because of relationship. And so I think that's what a lot of it is. They're not going to a wide audience. They're going to specific known operators that they have a relationship with and saying, hey, we'll give this to you.
Makes sense. Makes sense.
How many times trailing 12 months are you buying it for? 0.7?
Say it again. How many what in 12 months are we buying for?
The trailing percentage. You're usually buying it 3 at the top, but what are you guys ending up at?
When we're talking about hospitality?
Yes.
Okay. For multifamily, we generally will always look at a T12. For hospitality, it's a little bit more of we know how bad things are right? Because of COVID. And so it's more of a forecasting, underwriting of future performance based on similar properties in similar areas and different, pricing assumptions and occupancy assumptions. So it's more based on different scenarios of how fast things will bounce back. And, we're not anticipating you'd see the pre-COVID occupancies until 2-3 years in, as an example. So it's more of a future underwriting than necessarily just looking at the last few months, because almost everywhere, if you're being presented with a deal that's that good because someone defaulted, that T12 is going to look pretty ugly. Now, at the same time, that's more on the revenue side. That there may be some indicators on the expense side. Typically what we do is move from a national property management firm to a regional property management firm for a number of reasons, and also look for expense inefficiencies that can be cut. Does that answer your question?
Yes.
Okay, cool.
All right. Any other questions or any other topics? If you got, any real estate related questions, maybe Aaron and Wayne, you can touch upon the benefits of hospitality as far as operations versus multifamily. Like, what are, for example, right off the top of my head, is no evictions, right? No, it's probably the most efficient use of space, right? It's very compact. The structure is very compact, and you're getting premium dollars for the square footage, right? And so I see a lot of advantages, but maybe from an operations perspective or from a analysis perspective, can you share some insights on, not so much that one is worse than the other, but what are some of the factors that you think make hospitality a little bit more attractive, compared to, let's say, multifamily?
When you want to take a first crack at that one?
Sure. Well, hospitality, I feel like it's one of those situations where, if you look across all asset classes, there's like a general kind of risk versus reward comparison, where, the longer lease terms tends to be slower moving, and hospitality is as real time as it gets, right? So things change on a daily basis. So we feel that in this environment where it is acutely affected because of COVID, the value right now to buy hospitality and the upside when it does recover offers the most ROI for the risk profile.
Mm-hmm. And as far as operations, like how do you manage the front desk, and I know this is more of an operations questions, but front desk, maintenance staff, right? You probably need a full-time on 20, like a maintenance staff. But other than that, of course, you need the cleaning people, right? You need the crew to do the cleanings, and maybe if they have a small breakfast or whatever, I think those days are gone. It's probably, pre-packaged. Like I went to a hotel the other day and it was all pre-packaged stuff, and there was, there was no kind of buffet or anything. So, but from a kind of a labor perspective, like how do you analyze those numbers compared to a multifamily?
Yeah, so obviously, I think multifamily is a lot more kind of operationally passive, let's say, right? Things don't need to be, you don't need to have that much of a staff You don't need to have like ongoing marketing. You don't have to have all these things that are more similar to a business, right? So hospitality is going to be a lot more operationally intensive. That's why, you know, choosing the right operators for a hotel is absolutely key. So, I mean, from an investment perspective, there's usually a lot more meat on the bone, if you will, because, you know, the variance in how you operate a hotel to that hotel's value is there's a much bigger range, right? So a poorly operated hotel just has a lot more meat on the bone than a poorly operated multifamily, right? So you can squeeze a lot more ROI by making operations more effective, making marketing more effective on the hotel side. You'll make like basically value add opportunities tends to be a lot more lucrative on the hotel side. So the key is to have that right team and identify the right deals. And the upside is dramatic. Versus multifamily, I think the range is definitely smaller.
Got it.
So how do you evaluate the hotel deals?
Just in general?
Yeah, how do you underwrite them? How do you come up with the price valuation?
Sure. So, I mean, I think there's kind of like two components to that, right? Like one is, it's more similar to, you know, underwriting a private equity deal, right? So you kind of underwrite the revenue side. You do kind of the quality of earnings on the revenue side and figure out, you know, you're basically within that market, within that brand, what is typically if it was operated optimally, what is both kind of the price and the occupancy on a daily basis, right? So you can use those metrics. I would say like in general, hospitality just has a lot better metrics, you know, general market metrics than multifamily, because, you know, it's dominated by these large franchises, right? And these franchises will give you the data. So I feel like data is a lot more readily available if you want to kind of compare this particular property to, you know, all the other properties in the same area. So I kind of feel like in that sense, it's actually a lot easier to underwrite. So you could see, you know, based on the location, how well the property is performing compared to par. So that's kind of the revenue side. And then the expense side, I think there's kind of general industry standards on, you know, percentage of labor to revenue, you know, percentage of, you know, cost of goods for your restaurant inside. I mean, it's fairly similar to underwriting any kind of business, right? So I kind of feel like the visibility of that and the metrics that are available as par is a lot more readily available than multifamily.
Got it. Makes sense. All right, folks, let me know if you got any more questions, but, you know, I want to respect your time as well. So we're at the 1 hour mark, but we will be doing a third presentation on this on December 8th. So if you come up with any other questions or just want to listen in on the third presentation, you know, we'll again, that's on our meetup page, December 8th. We're going to do it in the evening. So please feel free to RSVP for that one. But Aaron and Wen and everybody, hope you got some new nuggets of information and knowledge out of this. But thank you everybody for your time. And you know, we'll see you. We'll see you on the 8th, or we'll see you in the accredited investor presentation, which will be soon after the 8th. So Aaron and Wen, any last comments or ideas.
Love to stay in touch. Our contact info is on the screen.
Yep.
And, you know, we're a little bit different than maybe some sponsor general partners. We like to create a community of people. Some of our investors can attest to how we have a mastermind group, and we like to make things educational like this session is. So it's not just about like, you know, give me a check and leave me alone. It's like, let's create a community. Let's help everybody be more interested. And we help actually a lot of our limited partner investors analyze and make decisions related to their own portfolios as well. You know, we just want you to be successful and a knowledgeable investor.
Absolutely. So yeah, I know I can vouch for that, and many of our investors can vouch for that. So look, we're in this together. So transparency and knowledge and sharing of knowledge, it's all part of our DNA. So but yeah, if you got any questions, reach out to Aaron and Wen, myself, whatever you feel is appropriate. But thank you for your time, and we'll see you in a week or so.
Awesome.
Thanks everybody.
Thanks,
all right.
Bye.
Bye-bye.